Stock investing for beginners. Last week I talked about 4 stocks. Today I'm going to talk about 3 stocks going to report earnings this coming week, and also what happened last week, and also what's going to happen this week. Business news, economic news, all the important things. And also I'm going to show you how to look at the stock to know if that stock worth considering. If they don't meet my criteria, you don't even have to think about it. So US payroll rose 199,000 in November and employment rate falls to 3.7%. So it's much better than expected. So the estimate was 190,000. October gain was 150,000. So November looks like lots of companies try to hire employees before the end of the year. Well, normally it doesn't happen very often, but this year, US economy reported really strong GDP growth last quarter, 5.2%. So it's no surprise that we have really good job gains, and also an employment rate declined to 3.7% compared with the forecast for 3.9%. So it's a good thing. And also, average hourly earnings increased by 0.4% compared to for the month. And so also 4% from a year ago. Close to expectations. Remember, no matter how much job growth, wage growth, they cannot grow faster than real estate or stocks. So that's why I prefer to invest in stocks, especially the stocks. Real estate, yes, you can buy a house, but it may grow for 3%, 5%, 10% a year. But stocks, you can magnify the return by using options, call options, put option, and advance option. And I'm going to show you that great companies can grow 10 times, 100 times, 1,000 times over your lifetime, maybe 20 years, 40 years, 50 years. But if you own real estate, it's really hard for the house to grow in price 1,000 times. So healthcare was the biggest growth industry, adding 77,000, and other big gainers included government 49,000, manufacturing 28,000, leisure and hospitality 40,000. And what happened after this news came out? S&P 500 jumped 0.41%. It jumped in the morning, but it dropped a little bit. Then it closed higher before than the previous day. And Nasdaq, the same way, it jumped, it dropped a little bit, but closed higher. Over the 5 days, it was up 1.66%. So year to date, it's up 38.67%. So if you look at it, if you invest in Nasdaq at the beginning of the year, you will have made 38.67%. So that means invest 1,000 at the end of year to date, and you will have your 1,000 will have become 1,400. So extra 400. It's very hard to get this gain in real estate or in putting, definitely not by putting in money in your bank. S&P 500 year to date 20.4%, and Dow Jones, it was up yesterday the same way. If you look at it, S&P 500, Nasdaq, Dow Jones tend to follow close to each other. So they went up in the morning, then they drop, then after that they close higher. The same pattern. So if you look at year to date, it's up 9.39%. Yeah, Dow Jones, I don't really prefer Dow Jones industry average because they don't really perform very well over the 5 years. If you look at 5 years, Nasdaq performed 108% gain, S&P 500 77.09%, Dow Jones not so much. So let's look at the 4 stocks that I talked about last week. Last week I talked about in the live 4 stock watch list, what happened. You can go to my YouTube channel, click on live to watch past live videos. Play Dave & Buster, it jumped. The restaurant industry over the 5 years, it's not moving that much. So that's why I'm not really interested in this stock. So the criteria, I'm going to show you the criteria in a little bit. So if this restaurant does not meet my criteria, so we don't have to look at it. But yeah, short term, you can do short term trading. If you believe that more people are going out to eat and their financial gonna improve, you can try to trade this stock. This is not financial advice, but you can do based on the information that I provide. You can make intelligent decisions. Look at Toll Brothers. Toll Brothers jumped 5.52%. Year to date is up 83.59%. 5 years is up over 188%. So it's almost like all-time high. So you might ask, oh, should I invest in a stock like this? Remember, the reason why stock go up all the time is because it's a great company. Without being a great company, the stock price cannot go up higher. So do not think that, hey, this stock is all-time high, it cannot go higher anymore, it could come back down again. Great companies can go up tremendously. All time is the percentage jump is more than 4,000. Can you believe that? So you just multiply with 10 times, so it's like 440,000 times your money. So for $2 to 92.86, that's a lot of money. So of course, there's always a time when the recession hit, the stock could go down. That's an opportunity. But why did this stock jump after earnings? Toll Brothers lower price homes translate to selling more homes, so there are a lot of demands. Toll Brothers is known to be luxury home builders, so their homes prices usually is above 500,000, 1 million, 2 million. So when they try to sell lower price homes, a lot of people buy homes. For when I was a real estate agent, I like Toll Brothers houses, and that's why the stock price jump, and also there are still demands. So if you look at home builders stock price, it performed really well. Next year, when the interest rate goes down, if the home demand pick up again, this stock could go up further. But would I invest in this stock? No, this is not the business that I'm really interested in. I have capital in other companies, other stocks, so I'm not gonna be invested in this stock. But I could use call option. If you want to trade, if you don't want to spend so much money, you can use call option, buy call option. Then you just need to invest a little bit of money and ride the wave up for that. Another stock that we talked about last week is AI, C3 AI stock. It dropped over 7.89%, but initially it dropped about 10%, but it's just bounced back again. So would I invest in this stock? If you look at year to date, oh yeah, the performance has been really great, 155.37% because of AI hype. So I look at the companies, is it more than 10 years in business? Yes, it's more than 10 years. How about the public companies? Is it more than 5 years? No, it's not more than 5 years. So that's why I'm not going to be investing in this stock. Another thing is, if you look at over the 5 years period, the stock price dropped. But could it be a good trading stock? Yeah, it could be. Every time a stock drops so much, 10%, 20%, whatever, if the company is going to be operational in future, like the company is not going to bankrupt, it can rebound. It can bounce back again. But the drop is due to the bankruptcy. Hey, the company is going to bankrupt. They are running out cash, or they want to raise more capital. If operation is in concern, it's very hard for the stock to bounce back. Even if it bounces back, it's so risky. The stock can stop trading anytime, and anything can happen. I prefer to avoid trading bankruptcy stock. So never trade bankruptcy stock. But C3 AI is going to be operational, I believe, in the near future, at least for the next 1 year. So you can rise the bounce back by using call option if you like it, buy call option. But would I be investing in C3 AI? No, it's not the investment stock. Trading and investment is different. Investing is like marriage. You want to own that stock for life as long as possible. So that's why you invest in stock. But for trading, you look at the price action, that if it's going to bounce back again, then you ride the wave up. Otherwise, you don't do that. And another stock that good reported last week was IH. IH dropped by 14.79%. Year to date, it dropped 4.45% because it's a home furnishing company, and lots of home buyers, etc. They are not moving a lot. If they move a lot, of course, they can buy furniture, new furniture, chandelier, light, all the new furniture, because not many people are moving. Sellers, they want to sell their homes. Buyers, they want to buy their house. So in that situation, RH perform really bad. Their revenue dropped by 14% year on year, and that's the reason why the stock dropped. And also, it's targeting luxury segment. So when interest rate goes up, and if there is a less demand for moving from one place to another, and this stock does not perform really well. And I believe the management is not doing a really good job. But could you trade? Yes, you could trade, but it can bounce back maybe in a few days. It can be a few weeks, 1 or 2 weeks, depending on that. So you can trade if you want it. And if you want to watch more live, you can go to my channel, click on live. And last week, the major US economy report, Federal order was down 3.6%. And services PMI is on forecast, the same as the forecast. Services, it even jumped 52.7%, more than media forecast as well. And ADP employment rate, ADP employment rate was down, had only 103,000 compared to 128,000 forecasted. US trade deficit was worse than expected, and also initial jobless claims is less than expected. Usually when the past 3 or 4 months, if the jobless claims is more than expected, more than 223,000, the stock markets tend to jump. If it's less than forecasted, the stock market tend to drop, because people are thinking, if jobless claims, if people are keeping their jobs, Federal Reserve's gonna raise interest rate to cool the economy, to reduce the inflation rate. Now, stock market doesn't care anymore, because there's a lot of cash on the sideline. So a lot of people want to buy any chance they get. So the stock market did not drop at all. So the correlation between bad news, stock market goes up, good news, stock market goes down, it's not there anymore. So a lot of FOMOs are coming up, and I believe in next year, January, February, there will be more FOMO, and lots of fund managers are going to put more money into the stock market. So the best time to buy was last year, October 2022. And for this year, the best time to buy was also October 2023. But second best time could be in December. Any dip that you see, if you like a company, if it's undervalued, you can just buy it. US employment report is better than expected, and stock market also went up. So usually, if it's better than expected, the stock market went down in the last 5 months or 6 months, but it's not the case anymore. So last week, Google launched AI model Gemini. So the Google stock jumped because executive said Gemini Pro outperformed OpenAI GPT 3.5. Google jumped over the past 5 days. So that's why I believe Google is the most value. What I'm trying to say is undervalued stocks among the Magnificent 7. So I'm still bullish on Google. So the price is still right. Over the past 1 month, it dropped a little bit. That was a good opportunity to add share. Look at that drop. Add a share. You can add share right here. So All-time high for this year is 141, so we still have some time. So I might add more Google to my position. And let's look at 3 stocks going to report next week. It's going to be Pepsi. Pepsi is a consumer staple stock. They also have other snacks. They not only sell Pepsi drink, they also have snacks as well. And they are down 7.65% year to date because people are not concerned about recession anymore. So when they are not concerned, they tend to damn consumer staple stock like Pepsi. But over the 5 years, it's up 45.4%. So what are the criteria that I look at when I invest in stock? Number one, do I like this business? Pepsi, yes, it's a consumer staple business. I prefer technology, but I still like consumer staple. Yes. Then second, has it been in the business for more than 10 years? Yes, since 1965. Third, has it been a public company for more than 5 years? Let's look at that. Yeah, it has been a public company since 1983. Fourth, how about the last 5 years stock performance? Has it been going up? Yes, it has been going up. 5, I can go and look at financial statement, balance sheet, and see their revenue, their net incomes, their cash flow. If I like it, I'm going to invest in Pepsi. But this is how I look at it. If you know how to look at the stock this way, it's very, very hard for you to lose money, for me to lose money. Of course, it's very, very difficult to make money in stock markets because people do not follow these simple criteria. They listen to their friends, their family, or anybody, or even they chat online, chat forum. Oh, this stock is hot. They tend to invest in that stock and they lose money for that. So only listen to expert, not necessarily. You have to do your own due diligence. Listen to the expert, use their informations, and also do your own diligence. Like, you can watch my YouTube channel, you can get information. Oh, Pepsi, yeah, I talk about Pepsi. Put it in your watch list, then you study yourself. If you like the business, then you can invest in Pepsi based on your own conclusions. The next stock gonna be the Charlie Munger. He likes that stock a lot, and he's a right-hand man of Warren Buffett. Without him, Warren Buffett would not have as famous or as rich as he is right now. So he passed away on November 28, and Costco is his favorite stock. So Costco is a membership grocery store, a really, really big chain grocery store in US. And you can pay for membership for over $100 every year. Then you get discounted price. And if you have a family of 4 or more, it's really worth it. It can be really worth it to buy shopping. Their toilet rolls are really big. You can shop their roasted rotisserie chicken, and yeah. So I don't usually shop at Costco, but it can be good opportunity for people with big families to shop at it. And although the stock price performs really well, year to date is up 34.75%. Over the past 5 years, it's up 194.9%. Do you like this business? If you like this business, that means your first criteria. Has it been in the business for more than 10 years? Yes, it is. So it passed the second criteria. And how about public company? Has it been a public company for more than 5 years? Yes, it has been. Criteria number 3, it passed criteria number 3. Then number 4, how about the past 5 years performance? Yes, it's over 194.9%. And you can go and look at financial statement, balance sheet. If you look at a company, a business this way, it's very, very hard for an investor to lose money this way. That's my criteria. So I never lost money for any stock that I use this criteria. I only lose stocks that I invested based on my friend's recommendation or based on what other people say. And the next stock gonna be Darden Restaurant. So they are reporting on Friday, December 15th. And you might not know this name, Darden Restaurant, because they have so many different restaurants under the different names Olive Garden, Longhorn, Cheddar's, Yard House. Oh yeah, you already know all these restaurants now already. So Olive Garden, yeah, they are really good with pasta, shrimp, scampi. They are really good. I travel around the world. I don't really eat pastas when I visit Southeast Asia, and I probably like pasta in Armenia, Western Asia, and also Europe country. And in America, yes, I like shrimp scampi. They are really good. Olive Garden is not so expensive. It's not also so cheap either. It's middle class restaurant, Italian restaurant. And another restaurant that they own is Longhorn Steakhouse. It can be really a little bit pricey, Longhorn Steakhouse in America. And another restaurant they own is Cheddar's. Cheddar in America, usually they have different restaurant in their own buildings. It's not like Asia. They have really big shopping malls. They have so many different restaurants in a shopping mall. In America, it's like individual restaurants, places like that. And Yard House is famous for beer, really big beer, burger, French fries as well. And yeah, DRI, has it been in the business for more than 10 years? Yes, it has been. Do you like business? If you say you like it, then it's gonna pass two criteria. Then has it been in a public company for more than 5 years? Look at that. Yes, it has been a public company for more than 5 years. You see, it's more than 2,435 times the money. Is a lot. 10 times, 100 times, 1,000 times. And it passed three criteria. Number 4, the past 5 years, has it been going up? Yes, it has been going up. So then the last criteria is you just look at their financial statements, balance sheet, how it performs over the past 5 years. If you like it, you can start investing in this stock. Dividend yield is only 3.3%. P ratio is 19.78. It's not so bad. But P ratio doesn't tell the whole story. So I intend not to look at the P ratio at all. So that's why P ratio is not one of my criteria. It's really important. And if you want to learn more about stock investing, option trading, you can go to my playlist. You can watch advanced option trading and how much I made, bond investing, and go for my favorite stocks. Click the link down below if you are just starting out to open a stock brokerage account. Share, subscribe. I will see you in the next video.